Hello and welcome. My name is Ed Newton with Newton Wealth Management. We put these podcasts together to help you as you continue along the path to achieve and maintain a worry-free retirement. We hope you'll enjoy this one and find it beneficial.
Hi, I'm Elizabeth Newton, and I'm the Vice President of Client Engagement. Clients frequently ask us if they should pay off debt, such as credit cards, student loans, and even their mortgage, before they should invest. Choosing between paying down debt and investing can be like trying to solve a riddle. And if you've ever tried to work out the answer, you've probably run into some version of this advice. Compare the interest rate on your debt with the return you expect to earn on your investments, and put the money toward the option with the higher percentage figure. While that advice might make sense in theory, it isn't exactly easy to put into practice. Plus, even seasoned experts find it difficult to forecast precise return rates, so it hardly seems sound to base your decision on a single number plucked out of thin air. So let's talk about the rule of 6%. We've crunched some numbers to come up with a clearer formula. And what's our conclusion? For many people, it generally makes sense to first pay down any debt with an interest rate of 6% or greater. Now, this assumes you have at least 10 years before retirement, that you're investing in a balanced portfolio, and that you're investing in a tax-advantaged account, such as a 401k or IRA. If the interest rate on your debt is less than 6%, and again, based on our set of assumptions, it likely makes more sense to invest those extra dollars instead. That's because at lower interest rates, there's a greater chance your long-term investing returns will beat the bang for your buck you'd get by paying your debt off faster. So the question becomes, how should you adjust that 6% number for your own personal circumstances? Although 6% is the number to remember if you have a balanced asset allocation, you can consider a higher or lower threshold if you invest more or less aggressively. Here's what the critical number looks like at different levels of aggressiveness, in each case considering a 35-year-old investing for retirement in a tax-advantaged account. If you're less aggressive, 5% may be a good number for you. And as we just discussed, if you're invested in a balanced portfolio, 6% may be the appropriate number. And if you're invested more aggressively, then you may want to look at 7% as your number. So why does the relevant figure change with your asset allocation? Well, a less aggressive investment mix, meaning one with a lower allocation to stocks, should typically generate slightly lower returns on average over the long run. And the reverse goes for a more aggressive asset allocation. A greater allocation to stocks can translate to higher expected returns on your investments, and means investing should come out ahead over the long term, even if your debt has a slightly higher interest rate. Now, when should you consider our rule of thumb? While the rule of 6% is easy to remember, there's some fine print to understand before you try putting it into action. Namely, you should make sure you're checking off a few other boxes on your financial to-do list first before you even get to the question of paying off debt or investing. So what should you do first? You want to make sure you're paying at least the minimum on all debts. Then you need to put away some emergency savings. Now, this doesn't necessarily have to be into a savings account, which these days pays almost nothing, and we'll talk about that in another podcast episode. Third, you want to be sure you capture any employer match on your retirement savings, and then you want to pay off credit card debt. Why do these other items take priority? Paying your minimums, socking away a cash buffer for emergencies, and digging out of any credit card debt are crucial to establishing basic financial security. Plus, it protects your credit score, so that your finances could survive any unexpected curveballs life may throw your way. And any employer match is essentially free money, which you should generally try to capture in full. In summary, consider the rule when deciding between investing unmatched dollars towards retirement or paying down debt. And if you have more than one debt at or above the relevant interest rate, work first at eliminating your highest rate debt, then move on to your next highest, and so on. So here are a few key takeaways. If the interest rate on your debt is 6% or greater, you should generally pay down debt before investing additional dollars towards retirement. This rule of thumb assumes that you've already put away some emergency savings, you've fully captured any employer match, and you've paid off any credit card debt. It also assumes that you're investing in a tax-advantaged account and that the interest on your debt is not tax-deductible. While 6% is typically the critical number if you have a balanced asset allocation, the right number for you may be higher or lower.
We hope this information has been useful to you. Our goal at Newton Wealth Management is to help clients achieve and maintain a worry-free retirement. We are a fee-only firm. That means we don't receive commissions or any other compensation from the investments that we utilize. We have a fiduciary responsibility to our clients, which means that we always put your interests first. If you haven't set a plan or are not sure that your plan is appropriate for your goals, we would be happy to talk with you and see if there's anything we can do in order to get you on track so that you too can achieve and maintain a worry-free retirement. If you have $250,000 or more of investable assets, I would invite you to visit our website at www.newtonwealthmanagement.com. There you can find out more about our firm and the services we offer. Again, the website is www.newtonwealthmanagement.com. From the website, you can also contact us to request a no-obligation, no-fee consultation. We look forward to hearing from you at www.newtonwealthmanagement.com. Newton Wealth Management is responsible for the content of this podcast and reflects the current opinion of the speakers. It is based upon sources and data believed to be accurate and reliable. Opinions and forward-looking statements expressed are subject to change without notice. Securities offered through Archer Investment Corporation. This information does not constitute a solicitation or an offer to buy or sell any security. A risk of loss is involved with investments in stock markets. The commentary provided should not be regarded as personal investment advice. Past performance is no guarantee of future results. You should carefully consider investment actions in light of your goals, objectives, cash flow needs, and time horizon.